My next guest says the fighting over a shutdown is merely a proxy for a larger debate over America's finances and sees austerity as a distinct possibility in the near future, especially as bonds continue to sell off. Joining me now is Dan Clifton. He's head of policy research at Strategas, a Baird company. Dan, welcome to you. Just riff for me. I mean, what are you thinking as this all plays out?
Well, Kelly, first, thank you for having me on today. As you know, we've often talked about this idea is that when your debt servicing cost hits 14% of tax revenue, the bond market starts to act very funny. And we hit that number in July. The 10-year yield's gone from 3.96 to 4.6, really just in 2 months or 2.5 months. And now we're here having a children's debate about whether to remove the Speaker of the House.
Right.
When you look under the surface, what we have are two competing thoughts. One, brinksmanship. And two, whether we need to get the fiscal house under control. When you have a low debt servicing cost, you're more worried about brinksmanship. Now the market's saying, well, wait a minute, can this group of Congress be able to start getting our fiscal trajectory in a better place, and don't really believe that they need to. So we're in this constant struggle, this budget trench warfare, as we like to call it, that will continue through the remainder of the year. And overhanging that is whether you know who's going to be the leader of the Republican Party. So I do think that you're starting to see the market begin to worry about these debt issues in a way that we really have not seen since 1981, 1982, the last time our net interest cost, our debt servicing costs hit these levels. And this is a really critical stage that we're facing as we want to start thinking about the fourth quarter.
It's fascinating because literally everything you've warned about has started to play out, almost textbook. But no one else in Washington, the spending wasn't even part of this fight. You know, all they did was cap spending for 2 years at the deal back this spring. The deficit, meanwhile, kept getting wider than expected. Treasury had to increase its issuance, and that's kind of what's gotten us to this situation. But still no one in Washington seems to be realizing or taking notice or acting with any urgency. So what's the pain point? What level of the 10-year or what has to happen in the stock market?
Exactly right. The conversations I'm having with investors this morning is that there's no realization, no wake-up moment. And so that we'll continue this trajectory until something breaks. That's the concern. I think you nailed it perfectly. But think about this. We've been in a period of stimulus for 25 years. We could cut taxes, increase spending, Obamacare, Trump tax cuts. We can do it all and not increase our debt servicing costs, and that's over. It takes a long time for members to realize that. In fact, there were meetings going on the Hill last week talking about doing an unpaid-for tax bill at the end of the year that both Democrats and Republicans support.
Wow.
That seems less likely to us, but it just tells us that what's happening in the markets has not caught up with Congress yet. And at some point, we're going to get there. A 5% Treasury, which was unthinkable for most investors a few months ago, looks very, very real today on the trajectory that we're going. If you line up yields with today, with 1987, it looked very similar before things ended up breaking. Not saying that's our base case, but you're starting to see those worrisome signs. I would also note, listen to what the Fed was talking about today, that financial stability needs to be wrapped up into monetary policy. Those are important comments being made by the Fed because they're telling you that they're starting to be stressed back into the banking sector, something we haven't seen since SVP. So those pressures are there under the hood. They probably got to go a little bit more before people realize that. You're asking people to change their 25-year framework. It's changed. They just haven't recognized it here in Washington.
Yeah, and looking through the projections, and this was from February, but basically the deficit, which was 7.5% of GDP this year, a record non-crisis high, is expected to be 5-6% for the next 10 years, and half of that is interest service costs. So. And that was, again, from February, before rates are where they are now. So the problem is, it seems to me, it's hard to pull that back, right? When you look at the spending this year, there was really no one factor driving it. There was a lot of factors, and it's about 3 points higher than normal. And you look at the revenue side, and it's basically in line with normal, around 17% of GDP. So can we raise revenues enough, or can we really reduce spending that much? I don't understand how that's going to happen.
It's going to be tough, especially before a presidential election. And then next year, Kelly, as you know, you have all of the Trump tax cuts expiring on individuals. So higher AMT, higher income tax rates, lower child tax credit. That's probably going to have to be paid for no matter who wins the presidency, something that we haven't done before. So there are a lot of pressure points here. I think it's going to be gradual. And in 1981, what started to happen was Social Security's solvency started to pull forward. That ultimately forced the Greenspan Commission to come up with ways to make Social Security solvent That's probably what we're going to see after the 2024 election. But we're a long way away from there, and you're starting to see the pressure building underneath the hood. And I just don't think there's a realization here in Washington. You're going to need financial conditions to tighten more before they get the joke.
Right. And if there's a recession, then the revenue side gets worse.